Voice, Manishi Raychaudhuri, Asia Pacific equity strategist at BNP Paribas. He's joining us on the show this morning. Manishi, thanks very much for joining us and great to hear from you this morning. Lots been happening, lots of moving parts, not just domestically but globally as well. But last week's rally was, purely domestic driven and the news flow thereabouts. Sitting outside India, did you look at this as a big re-rating opportunity for the country?
I think the first order or the immediate impact was priced in over last Friday and Monday, where the market moved up about 8 to 8.5%, because the overall earnings impact on the market as a consequence of the corporate tax rate cuts was in the range of 8 to 10%. Now, the second order impacts are more difficult to quantify. If you look at two aspects of the economy, investment and consumption. I think on investments they are easier to assess because a cut in tax rates clearly increases return on equity of projects, and as a consequence the return on equity to cost of equity gap, which is usually the driver of the viability of a project, that tends to expand. On consumption they're more difficult to quantify, because it could come in two ways. Number one, increased employment generation, but that obviously would take considerable time. And second, if companies pass on part of the benefit to their consumers, like some of the auto companies have done over past few days. So I think there are certain sectors which tend to benefit more. Some other sectors would possibly benefit at a later date, and that benefit would be more long drawn out. But overall, it's clearly a positive for the market, which was, almost kind of crying out for some fiscal stimulus.
Manishi, good morning. Neeraj here. Do you reckon that the up move that we've seen post that announcement takes care of all the near-term upsides, or do you reckon that once this earnings season Q2 starts rolling out the numbers and some companies start showing those benefits, if at all, then we might actually see some bit of return of momentum after the pause that we've seen post that big flare-up?
I think the immediate benefit is almost entirely factored in. If you look at the movement in the market on that Friday and the Monday immediately following, the market moved up by about 8.5% or so. There are some stocks which moved up a lot more in the early to mid-teens. So the immediate tax benefit is possibly entirely factored in. So even if companies do show this benefit in the July-September quarter results, it's difficult to suggest that there would be a very strong market reaction to those numbers. I think the market would be more focused on the operating numbers now. They would be trying to figure out what the important sectors or the leading companies' performance are going to be over the longer term, whether the consumption slowdown that we have seen over past few months is whether there's any light at the end of the tunnel or not. So those are, I think, the more significant and long-term factors that the market would be focusing on now.
All right. How much do you think what's been happening globally is going to weigh down on sentiment? Obviously, one, the political uncertainty in the US with the whole impeachment, bit that's come out for President Trump. Then also, now capital market restrictions and how that pans out for between US and China, and how the rest of the emerging market pack plays to the tunes of all this.
Actually, this global political and geopolitical fluctuations, if I may use that word, they're possibly the most difficult to predict right now. And the translation into trade across the world, the trade volumes and trade growth, they possibly constitute the biggest risk factor. Apart from the global central banks and how they're going to react, but I think on the second aspect, that is the global central banks and how they're going to act with their monetary policy, their reaction function, we are relatively more sanguine. We think that the likely monetary easing that's likely to continue, and in fact we also believe that apart from interest rate cuts from both the Fed and the ECB would also engage in a second round of quantitative easing. But the geopolitical side, which is also translating into continued trade tensions, they're much more difficult to quantify and much more difficult to predict as far as the likely solution scenario goes. That's why it becomes very difficult to predict how the market is likely to behave. We think that over the fourth quarter, we are likely to see some degree of depreciation in the developed market currencies, whereby the emerging market currencies and therefore the emerging market risk assets are likely to benefit from some additional degree of fund flows. But at the same time, even such benefits can actually be very short term in nature. To put it in a nutshell, we are actually almost looking at the markets on a very short term basis now. For longer term investors, we are advocating much more defensive strategies which focuses on high dividend yield stocks, the domestic consumption orientated stocks, and also various other defensives whose earnings seem to be relatively protected.
Okay. Would you look at the heavy capex industries, infrastructure, and obviously with the push to infrastructure, the allied spaces as well, steel, metals, and cement?
Right. So, see, in the context of India, the situation becomes slightly different because of the various economic policies that have been undertaken over past few weeks. If I look at this corporate tax rate cut, it is clearly a push towards corporate investments because, as I said, usually an investment project, the viability of an investment project is predicated on the back of return on capital minus cost of capital, or when it comes to risk capital, it's usually predicated on the back of return on equity minus cost of equity. And this measure straight away leads to about 10 to 15% increase in net profits and therefore increases return on equity proportionately. However, I must point out that one has to pay attention to the cost of equity as well, because if the bond market is apprehensive that this will lead to a significant increase in the government's borrowing, then risk-free rates and therefore cost of equity could also go up, and therefore that ROE minus COE gap could be kind of neutralized. So, I think beyond this, one has to look at the government's plan about neutralizing this higher fiscal outlay. If that comes from significant degree of asset sales, which would preclude the government from borrowing more and therefore crowding out private investments, that would be a significant positive for the investment sentiment and therefore a significant positive for the entire industrials and construction universe. So that is what we have to figure out going forward. But prima facie, I think for Indian capital markets, industrials, industrial conglomerates and the construction and capital goods companies have got a boost as a consequence of these measures.
Okay, Manishi, afraid we're out of time completely, but it was so good chatting with you, and thanks for your insights into how the ROE and the differentials would help market participants try and value some of these companies in the near term. Appreciate your time today.
Absolutely.